Okay, why don't we begin? Good day, everyone, and welcome to the Pinnacle Partners Year-End Review and Opportunity Zone Insights webinar. I'm Jeff Feinstein, Managing Partner at Pinnacle Partners, and I will be your host today. We're excited to have you here as we wrap up 2023. There are 15 days remaining to invest in an Opportunity Zone fund to mitigate 23 tax in this particular calendar year. And today we felt it was extraordinarily timely that we delve into some crucial topics related to Opportunity Zone investing. We want to review some tax mitigation strategies, which we think are ever more important, and then provide you with a material update on our Pinnacle Fund VIII, the curated fund of 4 projects. Before we delve into the agenda, let's take a moment and reflect on this past year, and it's been a remarkable journey for Pinnacle Partners. So for those of you that are our investors and that know us, we take a very conservative approach to underwriting. And throughout this past year, we've been applying sensitivity analysis to our underwriting. And our underwriting is held together while we contemplated the following: 9% inflation rate, 5% treasuries, potential for banking crisis, increasing rates, and with no indication of a move otherwise. We also saw the supply chain constraints and the potential for recession. So we are running models continuously. We're anticipating any and all of these kind of negative effects on our projects and our ability to meet the return objectives that all of our investors expect. So we'll be talking about that, and very specifically, Jill Holman will raise the subject: why real estate now? Why multifamily real estate in 2024? So I'm looking forward to an engaging conversation. Q&A is available throughout. We'll dedicate some time at the back. We got a couple of polling questions, so let's get on with the agenda. Let us first remind you, if you haven't met us yet, we are Pinnacle Partners. We're exclusively dedicated to investing in opportunity zones. We were an early mover with our first investment in 2018. We've now capitalized close to $700 million of OZ projects, and we think the best opportunity zones across the U.S. We've aggregated $250 million of capital gains to capitalize these projects, the aforementioned $700 million in projects, and that represents 750 units of workforce and affordable housing. We think we're delivering on the spirit of the program and trying to bring much needed new housing stock to critical markets. We have 200 units of student housing, and what you'll find from OZ Fund VIII is this highly curated fund of 4, 2 NFL Stadium District opportunities projects, and 2 build-to-rent opportunities. And that was an interesting adjustment in our sourcing to seek these build-to-rent projects. We'll talk about the investment thesis and why there was an arbitrage available to us to seize upon and bring those 2 projects into our portfolio. So as a reminder, for those that are new to Opportunity Zone investing, we've been executing on this legislation, as I mentioned, since 2018. We believe it's the most compelling tax shield ever enacted by Treasury. And it provides 3 meaningful gains. So this is now the most tax efficient policy in place. I'll speak to the potential extensions of the program in just a little bit, but let's remind ourselves, what are the benefits from realizing a capital gain and investing that capital gain into an opportunity zone? When you do so, the legislation affords you 3 significant tax benefits. The first is you defer the tax on the capital gain. So you generate for simple math, $1 million long-term capital gain. You would pay 23.8% of that in tax. You defer that through April 15th of 2027. We look at that as an interest-free loan from the IRS during that period. And you put that money to work and create basis in a real estate asset. The second, I'm going to drop down to number 3. The second benefit is the use of depreciation throughout the holding period without recapture. So when you invest $1 into Tesla, you establish basis, but you don't get to utilize depreciation. Real estate has always been the most tax efficient investment asset class, and now with the opportunity zone, even more so. So you get to use depreciation to reduce your tax liability when income is generated, typically in a traditional non-OZ real estate transaction, you would have to recapture that depreciation. In an OZ investment, because there's a 100% step up, which we'll get to in a moment, there is no recapture. Very, very significant benefit. And the third, and we think the most extraordinary tax benefit, is after a 10-year holding period, you qualify for tax exemption. So if $1 goes in, it appreciates over time to $4. The $3 in appreciation is tax-free. You pay zero capital gains on that appreciation at terminal sale. And for this reason, we have been attracting sophisticated investors desirous of monetizing capital gains, offsetting those gains with the extraordinary tax benefits I just reflected on, and then begin establishing a diversification strategy that has an ever-increasing exposure to real estate. And again, we'll come back to why real estate in 2024, especially given the pivot yesterday. Now, the news was welcome. There was a remarkable and powerful rally yesterday. And as difficult as the last 1 or 2 years has been, we want to put capital gains in focus because there's some significant runs in the equity markets and other asset classes that we think are attractive for harvesting gains. And all you do is generate a capital gain, and you have 180 days from the realization of that gain to qualify for the tax benefits by investing in an opportunity zone fund. So I think everyone probably saw the headlines yesterday. Dow Jones at a record close above 37,000 for the first time. NASDAQ's up 41%. The S&P, by the way, I think is just 2% away from its all-time high. And crypto had a heck of a rebound. I believe the best performing asset class for the year, up 157%. And we talk to investors each and every day. They all have a different scenario, but they're all trying to be prudent to do, a rebalance of portfolio, to take a little off the table, to monetize the gain in these categories listed below. And we've seen an ever-increasing number of transactions supported by the obvious, number one, insider sales. You don't have to be an employee but a holder of Microsoft. You're at an all-time high, NVIDIA, Apple included, and there are many more at all-time highs. So people are trying to, I think we've gone through enough volatility. You're not seeking top ticking. You're seeking a prudent harvesting of gains after a significant run in the name. We are seeing real estate sellers come to us. They much prefer OZ investing versus the traditional 1031 exchange. There's a lot of benefits. If you are a real estate seller, you happen to be on the call, we can walk through the benefits, but suffice it to say, and we'll discuss it as a case study, OZ investing is far more flexible than investing via 1031 exchange. We're seeing a lot of mid-market M&A. You've seen some big-time tech moves of late. Cisco acquiring Splunk, Aptio, local Seattle company acquired by IBM. But then there are many small business owners, physicians of late, selling their practices in a consolidating market. That's a big-time liquidity event, and it's prudent to be tax efficient when you realize that substantial gain. Carried interest, for those that enjoy carry, is generally, if held less than 3 years, considered short-term capital gains. So we see a lot of hedge fund, private equity managers, not the funds themselves. Venture capital is seeking the tax benefits and the diversification into real estate. By the way, the OZ takes any source that is defined by the IRS as a realized capital gain, and that includes collectibles, art, cars, and then lastly, partnership interests. So you might get a K1, and those 401(k)s are coming later and later in the year, and many times our investors are surprised to see, oh, I generated more gain than I had estimated. And again, OZ plays nicely with partnership interests. So all of these are sources of capital gains, and they should be in focus at this time as you seek to be tax efficient, looking to mitigate taxes. The definition of tax efficiency is mitigate taxes, maximize return, and then preserve or compound wealth. So let's just talk about 3 strategies for tax mitigation. And they're pretty obvious, and I'll review these quickly. The first is concentrated equity position. So we see a number of Microsoft or Amazon employees with tenure, with substantial low basis stock, now having the opportunity to sell at all-time highs. Well, that's a great opportunity. And what you'll see, the recurring theme is you generate the gain, you put the basis in your pocket, that is tax-free. You invest all or part of the gain into the opportunity zone, now establishing basis, now establishing a real estate holding. And by the way, if you choose, you can reinvest in Microsoft tomorrow after transacting today. The real estate sale case study 2, we've seen a lot of primary residents downsizing, selling what is, and generating substantial gains. Once again, in this scenario, you put the basis, say you paid $1 million and generated a $2 million sale, put the basis in your pocket, and then invest the gain into an opportunity zone and receive all of the tax benefits. And then lastly, a lot of people think this is only for long-term gains. And therefore you're shielding at 23.8, also for short-term gains, short-term carried interest, as I discussed a moment ago, or maybe you bought NVIDIA before the run-up earlier this year. We've not yet crossed 12 months to seek, the long-term status. You might wish to transact. That would be at 39% rates, and you get to shield at 39%, making the imputed benefit of the imputed value of the OZ tax benefits even greater. Currently, most accountants will tell you the lift to an IRR is generally 4 to 6% when you account for the depreciation, deferral, and elimination. And then lastly, this program has been so successful. There is new bipartisan legislation to extend and expand the program. Now, Congress has been, let's just say, distracted and disorganized. We fully expect, and my partner Jill Holman was recently in Washington, D.C., we fully expect this will be taken up in 24. The program has yielded significant value. It's really an economic stimulant program. It's accounted for well over $100 billion of cap gains, and we estimate 7 to 10 times that in economic impact. So Senator Cory Booker, Senator Tim Scott, former presidential candidate, they have authored to extend and expand the program, which would move the deferral period out 2 more years to 2029, add back a step up in basis, and allow some fund-to-fund investing and some other reporting considerations. So we're watch this space. We're trying to track policy as it moves through the process, and we're hopeful that in 24 you'll see an extension of the program. Now, before we move on, I'd like to ask the audience a couple of quick questions via a poll. So if you'll allow me, let's just turn this poll on. First question here: which quarter in 2024 do you think the Fed will begin cutting interest rates? Maybe people have already responded to this. It's possible. Okay, people have responded. Well, if you haven't responded, please do. The next question is, do you currently have any realized gains or plan for realized gains? And do you intend to invest in an opportunity zone? So we're accounting for those responses now. Thank you very much. And we're going to move on with the agenda. I'm going to introduce my colleague, Jill Holman, and we're going to talk about why real estate. So again, we have entered a rate cutting cycle based on Fed Pal's remarks. We will debate, and people are prognosticating now if that's cuts in Q1 or mid-year. Nonetheless, given what I said at the opening, where we were accounting for 9% inflation and 5% treasury and supply chain constraints, we get now predictability that rates are likely to be reduced. And that is a significant and defining event for real estate specifically. And so now we ask the question, and Jill will lead us in this discussion, why now? Why is investing in opportunity zone real estate especially attractive as we move into 2024? Jill?
Great, thanks, Jeff. So the first is just talking about real estate as a hedge against inflation. And so historically, real estate has been an effective hedge against inflation, and data from the Federal Reserve indicates that real estate often appreciates at or above inflation. And so with rental property income keeping up with the pace of inflation and the ability to mark your rents to market, it helps preserve the value of your investment. And so that's one of the reasons is a hedge against inflation. Associated to that is real estate can also diversify your investment portfolio. And so whereas a lot of folks are on the equity side seek to diversify with buying different stocks, real estate is also in itself diversification, and then within our fund, we're diversified with our different geographies and different types of multifamily asset. And so with multifamily, there's a lower correlation with stock market performance, and that provides more stability even during market downturns. The next is leverage potential. And so while we all know we're in a higher interest rate environment, we are underwriting deals that need to pencil under this current interest rate environment. So we're looking at untrended return on cost, and then we look at and underwrite to our levered IRR and equity multiple returns. And so these higher interest rates make earning that return that much more difficult. And so I thought about this analogy, and that is, I think of it almost as, running with weights on. And so that is if you can run with the weights on and you can take the weights off, you find you just run that much faster. And so if you think about if our deals can work in today's interest rate environment, then as rates are declining, it provides that much more of a profitable spread, a spread over current cap rates that our investors would receive. So that I would consider a leverage potential. The next that we'll talk about is the strong demand for housing. And so even today, there exists significant demand for housing. I think all of us have read a lot about just a lot of these homeowners are staying in place, but that leaves a significant void with a decreasing supply of homes for sale. There's also the first-time home buyer. That percentage has decreased dramatically, and then also the average age of the first-time home buyer is in the 30s. And so what that indicates is that there's a strong demand for housing, and on the for sale market in particular, it isn't able to accommodate that. And so whereas a number of the markets across the country, particularly in the high growth area, have some shorter term supply challenges, the reality is that as these individuals are seeking homes, they're seeking rental homes because that's really the option that they have. And so this is, I would argue the housing demand is another strong factor for why real estate now. And then on a related note, we have then the long-term requirements of the OZ investment. They help justify the current cost of development. And so currently, and I would classified this as long-term stability and growth potential for real estate. And so despite short-term market fluctuations, real estate and often appreciates over time. And we talked about the hedge against inflation, but being an opportunity zone, structured as an opportunity zone investment, that requires a long-term hold. And so while if we're talking about a strategy of being just a merchant builder, being a developer that needed to exit after 3 years, I would argue that's much more challenging. But because this is a longer term hold, because opportunity zones requires a longer term hold, that enables us, all of us, the ability to weather short-term fluctuations in in interest rates or short-term fluctuations in the overall real estate market. And so that's this long-term stability and this opportunity zones in particular, this strategy, I think enables just more stability of a real estate investment compared to other types of investments. And then I would also tie that in with we've talked about the tax advantages. Jeff has discussed them as well, but related to this long term as a reason of why investing in real estate. What I'd also suggest is part of the reason we own real estate is for the benefits of depreciation. So investors can, myself included as an investor, we can receive the depreciation. So we can receive distributions, but the amount of tax that one pays on it during like the term of the ownership is less. And so that's the benefits of depreciation. But with opportunity zones, you get the depreciation without the recapture. And so that's a lesser known, but in fact a certain benefit. And so this, when you add this tax advantage of getting the benefits of depreciation without the recapture, and then you combine that with this long-term hold, long-term growth potential, long-term appreciation, it makes it very, very, very attractive. And then also what I would argue is with opportunity zones, while we think there's great potential for this bill passing and extending this program for another 2 years. It's also something that will expire. And so that's why I leaned into it, is that you have these significant tax advantages, but you also have, particularly on the multifamily and also real estate side, significant investment advantages for making investment now or very, very soon. And so that leads to the next conversation about, Fund VIII. And as we identified the markets that we wanted to invest in, we really focus on markets that are high growth, markets that are the cost of living is reasonable relative to the overall population. And so these were markets I'm sure you read about in the Wall Street Journal or your news about top places to invest. And so we did an analysis and identified the top markets that we wanted to be in, and that's where we sourced opportunities. But it's not just about finding the best locations, it's also finding within those markets the right submarket within those markets. And importantly, it's finding the right development partner, because these are people that all of us will have a business relationship for 10 years. And so we are thrilled about the locations of our assets and also about our development partners. And that's what Leo will talk about in more detail. So this is just an overview of where we put the targets and actually where we hit. And so we're thrilled about what our curated portfolio looks like, which properties are in that portfolio to really execute the strategy that we did. And now I'll hand it over to Leo.
Excellent.
Great. Thank you, Jill. And I will now attempt to share my screen and take over from Jeff. Is that working?
Yep.
Great. Well, thank you, Jeff and Jill. I always love ending with more detail on the real estate projects because I think a lot of us know about opportunity zones. I think Jeff does a great job of telling kind of the why and our history of how successful OZs have been in general. And, we're fortunate that Pinnacle started early. We're coming up on our 5-year anniversary for Pinnacle Partners. We funded 10 single asset projects on the West Coast. And I started talking to Jill probably 3.5 years ago, because she was also early on in the OZ space before us. And we decided collectively to come up with this curated fund of 4 projects in opportunity zones throughout the US in these growth markets that Jeff mentioned. We now are at our 2-year anniversary at the end of the year for Fund VIII. So what's, I think, very exciting for potential new investors is this really is last money in. Jill and I focus on the sourcing of projects, underwriting, and seeing the properties through the development phase and through the holding period. And Jeff and Blake, as a lot of that know us already, are kind of on the equity side and really help tell the story. But 2 years in, you might have heard our first webinars, almost 2 years ago. We had no projects identified. We kind of thought we had a debt project, in a term sheet. So it was much more challenging for us to really tell the story. We had our vision. We believed in our vision, but it was a much different market then than what it is today. Some better, some worse. But the challenging part was really finding projects with developers that really would meet our terms, because we definitely wanted to be the sole equity in each of these projects, have major decision rights, and really act as a fiduciary for our investors, but also like an institution would. We wanted to be able to control these assets along with our JV partners. So we're really excited to share, as Jill mentioned, in the map here, you see a lot of markets we focused in. Jill, I bet we've looked at almost 100 projects and maybe underwrote deeply at least 20 to 25. But today we now have 4 projects that we have closed our joint ventures on. 2 are under construction in Denver and in Charlotte. Phoenix will start construction next month, and Nashville, we're hoping to start late next year. So we'll go into these projects now. 2 years ago or 18 months ago, we put together a term sheet with Mortenson Construction, who also has a development arm. Mortenson's one of the largest general contractors in the country, based out of Minneapolis. And Jill and I both had a relationship with Mortenson, and we heard they had a project in Denver that they were looking to capitalize that happened to be in an opportunity zone. And I just want to start by telling you that, even though we're an opportunity zone fund manager, these projects that we underwrite don't include the opportunity zone benefits in our underwriting. I'm investing a lot of money through my 401k with non-gains. So we really believe in these projects. They have to hit our underwriting without this OZ tax lift. We'll start with that. A lot of people say it, but proof's in the pudding, because I'm investing a lot of non-gains in our own projects. This project took us almost 12 months from term sheet to finalizing our joint venture, where today we are now under construction. And you'll see some pictures here for this 200-unit, 8-story building over 2 levels of structured parking in Denver's Stadium District next to the Broncos Stadium. We're right on the South Platte River. We'll have views, as you see over here, back to the city and to the mountains. And we think this is a neighborhood called the Sun Valley neighborhood, which is already seeing some growth coming already. It just happens that a lot of these stadium districts around the country are in opportunity zones because they're more industrial in nature. And that was like this one. But it's right adjacent to downtown Denver. We're very close to you'll see a stadium district plan here, which our property here with the star, again, along the river, is one of just a couple fee simple sites that we were able to acquire. The balance of these properties here are owned by the Denver Broncos ownership group. So these will likely be on a land lease, but there is a growth plan here once they upgrade the stadium to also be developing in this neighborhood. So we're in here early, but today the neighborhood works. You know, again, proximity to the downtown. There's a campus over here of over 40,000 students, the Aurora campus with several universities. We're right in the middle of 2 light rail stations, so it's a very walkable neighborhood. And we like it as well because it's market rate units. We don't have to hit the premium rents. You know, none of the projects we've invested in have ever been high-level premium rent projects. We think when markets soften, those are the rents that have come down the fastest. So we're kind of in that workforce level of market rate apartments, which is much needed in this neighborhood.
And just to clarify, Leo, you made this point, but I just want to make sure that that's an artistic rendering of what could be built there in the stadium district, those buildings where the cursor is, as Leo described. And it shows just the location and the infill that's can happen and will happen, we expect. So I just wanted to make sure that was clear.
Exactly. And the Walton family, who have now bought the Denver Broncos, do have plans in place to either build a new or refurbished stadium. They also own, I believe, almost 100 acres along the other side of the river here with plans of more development. So we're in an area that is, you know, we're already seeing improvement. There's another development just down the street from us of multifamily, which we think is just going to improve the neighborhood further. But we have, in our opinion, the prime site, again, along the river. There's a long bike path along the river that you can bike or run to work, for exercise. Again, and it's 200 units right in the middle of an area that is growing. Here we have a webcam on site. These were taken about 2 or 3 weeks ago, so you can see that we're coming up with our pilings, and we'll be going, you know, doing our garage work here shortly, you know, in the first of the year. The other nice thing is that we were in the market for debt about Q2, Q3 last year. So we secured a very good loan at 250 basis points over SOFR, which is about 100 basis points lower than what you can get today. So a very attractive construction loan. And we're scheduled to complete first quarter of 2025. So that gives us time to kind of lease up and stabilize throughout 2025. So again, you know, top reasons here, we believe that the location, as Jill said, you know, we have cities that we've starred of what we like, but then we look at submarkets. So we bring in our experts, property management groups, capital markets team in each market that really we tour with, and we look at comps. Jill goes through units and really looks hard at our pricing versus what the market is. So we feel very good that this location we're hitting at a good time. And Denver is probably one of the tougher markets from what we're hearing in the country for entitlements, meaning building permits. And that's what took us almost a year to get through our process. But when you get permits, you're golden, because the next people trying to go get permits, it's going to take them at least that long. So we think the barrier of entry is very high in Denver, especially in the submarket. So the next project, Jeff and Jill both alluded to, build to rent. So we, about 6 months ago, met a developer called Trilogy Investment Company out of Atlanta. And they had started a new development firm focused exclusively on build to rent. And what build to rent is purpose-built communities, either townhomes or single-family homes for rent. You might have heard of SFR, or single family rental, where people were buying scattered homes, where you might have one home in a neighborhood for rent, but a bunch are for ownership. These are all for rent. So it's a new product class. It's really been very of interest a lot, both to groups like us, fund managers, but also to capital markets, institutions, fund managers, et cetera. Because people like to be in a community like themselves. So having a rental unit in the middle of 100 homes that people own, you don't maybe feel like you're in the community as much of a community of 100 homes that are all for rent. So think of it a garden style apartment community, just happens to be townhomes or single family homes. And when we met Trilogy, I'm going to go through the second project next in Avondale, because we closed on that joint venture with them first. But this project in Charlotte was 68 townhomes in an area in Charlotte called Noda, which is just a few miles from downtown Charlotte. Very cool, kind of hip neighborhood that has, a lot of mixed use restaurants, bars, galleries, etc. But it's, again, very close to downtown. And we had approached, or our partner approached, Pulte Homes, that was building 68 townhomes at the end of this mixed-use community in Noda that were for sale. The sales market was slowing down a little bit, so Trilogy approached them to see if they could buy these units, 68 townhome units, in bulk and put them in a build-to-rent portfolio. So that's what we did, is we've secured this joint venture to purchase these 68 townhomes at a fixed price that we are closing 5 units a month. And we've closed on 40 of these units. About 10 are for lease currently. We're putting about 10 in the leasing market per month until we close on all 68 units by mid-year. And the beauty of this is you're taking all the building permit risk, the construction risk off the table, and we're closing on these at a fixed price, again, coming on 5 to 10 units per month, and we don't have to lease them all at once. So you've got fixed pricing in a market that we underwrote, and we believe, again, adjacent to a very large mixed-use community that you'll have for rent, our 68 townhomes for rent, adjacent to another project next door that's under construction, which is multifamily, which will be in the middle of a master use development with retail, office, hotel, very close to light rail. Again, in an opportunity zone, because it's kind of an up-and-coming market that needed, infusion. And if you were out there, you would see a lot of this is under construction today. We brought this into the portfolio, not only that we liked the product type, but we really wanted to bring in a product that was going to cash flow sooner, because a lot of developments like Denver took us 12 to 18 months to get it to start building. And now we won't be cash flowing in 2025. This one will cash flow in 2024. So it will be current income into the fund, in 2024. So current pictures of the townhomes, again, that are being built. Very high quality 2 and 3 bedroom units with garages, all for rent. This is part of the retail facility that's part of this master use development that's underway currently. So the third project, as I mentioned with Trilogy, the first project that we were approached on with them was in Avondale, Arizona, which is just west of Phoenix. This is a 107-unit single-family townhome community. And the two strategies that Trilogy has, one is what we call a forward purchase, like we're doing in Charlotte, where we purchase homes that a home builder are building, like Pulte, and we purchase them when they're completed. The other strategy is to buy land at a low cost, take it through the permit and entitlement process, then bring in a home builder to build the homes. And that's what they're doing in Avondale. We came into this project about 6 months ago. We've just received building permits to start the horizontal work, roads, street improvements, etc. And then we will start the vertical buildings mid to late next year. But this is 107 single-family homes, again, 2 and 3 bedroom, with amenities such as a swimming pool, clubhouse in Avondale, which is right between Phoenix and the growing markets of Glendale, Arizona, Goodyear, Arizona. We've looked at a lot of projects in Greater Phoenix and actually have turned down probably more projects in Phoenix than any market we've looked at. But what we really like about this city specifically is Avondale, again, is a very high barrier of entry market to get building permits. And we are part of a mixed use community here. This is our site here, outlined in red. Right in front of us, there's 2 hotels that are under construction. There's office and retail being built and more multifamily. So it's another mixed use development similar to Charlotte, but we're part of a mixed use community that you can walk to services. And we're literally a mile from a Costco, grocers, and other services. So it's really more of an urban play for single-family homes in a very walkable neighborhood. So again, as Jill, and this is our site here in red. This is a hotel. This is about 3 or 4 months ago. So there's another hotel that's being built currently. Sorry about that. Right on this lot as well. This is a multifamily project that's being built next to us. So we're really bullish of the build to rent story. We do have another webinar that we did a couple months ago with Trilogy that if anybody's interested, happy to send you that recording because it really talks in detail. You'll hear from Jason Joseph, the CEO, why build to rent. One of the biggest reasons, other than the product type, is the rental profile and time for leases for these tenants is literally 3x of what multifamily buildings are. Multifamily average rent is usually 9 to 12-month leases, where single family and townhome rental, we're being told, is more like 3 times that, almost 3 years. Because you think about it, you get either couples that are leasing these, they have young kids that are growing up in these before they buy their first home. So, it's typically 3 times the rental lease terms in these buildings. And the fourth project is Nashville, and we have had this project in our portfolio, Jill, I think almost 9 months now. And
Yeah.
Yep. And this development partner is called Stillwater Capital out of Dallas. And they are known for building both high-end home division as well as multifamily. And they have a development partner in Nashville that sourced this site in East Nashville. So it's right across the river from downtown. And we like this submarket a lot because downtown, as you might know, has been booming. There's a lot of multifamily that's gone up and that's under construction. And when we see that, and same thing in Charlotte, actually, there's so much multifamily being built, we be very careful of the supply in these markets. So that's why we like build to rent in Charlotte, not competing so much with multifamily. In Nashville, East Nashville is another stadium district neighborhood like Denver, which was literally a mile away from the Tennessee Titans Stadium, which has been approved and is going forward on building a brand new stadium, which is going to fuel a lot more development like ours in this neighborhood. That stadium has its funding approved, and it's slated to be completed in 2027. And we're also right smack in the middle of the stadium and the Oracle campus here, which is about a half a mile from our campus as well, which is bringing almost 8,000 to 10,000 jobs to this neighborhood. So there's millions of square feet of product, both office and multifamily, hotel, retail being planned in this district. And we're right smack in the middle of it. So we've got a very good land basis. We're planning approximately 300 unit project there. Again, market rate. We don't like doing high-end units, where market rate units is the current plan. We did have to slow down for a few months because we're working with the city right now on some new roads that are being improved and going to be redirected from the stadium to the Oracle campus. Some pedestrian corridors are going to be connecting across to downtown. So all of that's good news for this neighborhood. For us, it's caused a little bit of a delay. So we'll be back probably in the next 90 days with an update on our timing. But suffice it to say, we think all what's happening around us, at minimum, it's increasing our land value and certainly improving this neighborhood. But what we've underwritten is 300 units of podium style multifamily in this neighborhood as well, that we're hoping to be able to start construction in Q4 of next year. So that's our portfolio of 4. We are constantly looking at, Jill and I are seeing projects at least 1 a week. With this environment, as Jill said, the merchant builders are pretty much out of business. You can't build, lease, and sell a project and call it 2 or 3 years because the institutions are out of business right now. They aren't looking to acquire assets. So developers that we're building with those kind of partners are now coming to folks like us saying, we're looking for private equity to fund our projects, which has allowed us to negotiate much better terms with development partners. So We're looking at other projects. As of now, again, we're a fund of four. We may be back to you in the next, month or two with an announcement of another project if it's extremely compelling. But for now, we're very excited to have this curated fund of four, and calling for a close by year end, as Jeff will kind of end us with, for a funding year end. And we're hopefully going to close the fund by at least the end of Q1 of next year.
Thanks, Leo. And we're taking questions now. We've got a number of questions. We'll go through them. But let's just review real quick, right? We open with a bit of a celebratory tone that the Fed has pivoted. Rates will be reduced certainly next year, and a lot of asset classes responded positively to it. For us to have that as we look towards 24 has just really been a significant upside to our planning and to our projects more specifically. We talked about tax mitigation strategies. So the OZ, with 15 days remaining, you can still mitigate 23 taxes. There's a question here regarding administration. I'll come right back to it, but it's very easy. And then we just reviewed our actionable fund of four, 2 stadium district deals, NFL stadium district deals, paired with 2 BTR deals. And as you can see, 3 out of 4 will be under construction. And as Leo described it, last money in, because we already have about $63 million in the ground, and we're just using the balance of our equity to obviously finish construction and lease up. So we think it's very highly curated, very compelling underlying real estate. And as Leo said, we underwrite everything very conservatively and without the OZ tax benefits. It's just good real estate, and the real estate just got better. So with all that said, looking at the Q&A, and somebody had asked the questions, I sold a bunch of stock, I realized gains, how do I redirect some or part of this money to an OZ while getting the benefits? Well, I'm going to interpret the question as to how do you administer the opportunity zone? And you simply identify your gain. Remember, the cash is fungible. It doesn't have to be the specific sale and the proceeds associated with it. You have a gain of $100. You've realized that gain. There's a timestamp on that. Again, it could be from an equity sale or partnership interest and otherwise. So you then, once you transact that, you're eligible for the opportunity zone benefits. You simply inform your accountant of the gain you wish to invest, all or part of it. You don't have to put all of it. You can mix short and long term. And then you schedule those gains and you pair them with the opportunity zone and the associated tax ID. And that is all that is required to qualify for tax deferral and all the other benefits that come thereafter. So it's very easy self-administration. The IRS page, FAQ page on opportunity zones is extraordinarily helpful, if you can believe it.
But Jeff, let me just add to that, because you're right. As an individual investor, it's fairly simple. It is simple. For Sandy Heffernan, our CFO, who I see the S on here, there's a lot of work that goes into compliance, and that's really where we come in with our professionals at Novogradac, Greenberg Traurig, and Sandy, working on our compliance. There's a lot of compliance that needs to happen for opportunity zone projects, and as I mentioned, we've got 10 that we've completed, and these 4 that are coming in. So we've got about as much experience as most, in the marketplace, and much of it thanks to Sandy.
And investors would, it's critical that they communicate with their tax professionals to let them know that they made an OZ investment, and so all of the forms are filed adequately.
There's a question here. To what extent can a person defer capital gains on the sale of a family-owned business? That would be in my list of kind of capital gain events to include mid-market M&A, small business sale, family, or maybe limited partnership. Again, anything that the IRS designates as a short or long-term capital gain qualifies for OZ tax treatment. And I would assume that a family-owned business sale would qualify. There's a question here about leverage, Jill. What is the amount of leverage? We talked about earlier our conservative underwriting. What is the targeted leverage ratios we seek. And we have, obviously, the Denver project is discussed going vertical now. So maybe we can use that as an example.
So with Denver, that was really capitalized, as we mentioned, before the end of 22. And I think we're in the 60 to 65% range. So we had a little bit higher leverage. But now we're seeing leverage in that kind of 55% range. And then we're underwriting refinance with the current agency guidelines of 1.25 or less than 75% loan to value, the lesser of, and current interest rates in the agencies that we've been seeing is sub 6%. And so that's how we're viewing the refinance, and the refinance would be taking place at stabilization.
Yeah, we've always preferred, less leverage, and we know that, higher leverage obviously helps in IRR, but lower leverage, especially in OZs, is works well, because then you can return more, hopefully at stabilization with a refi event.
So I mentioned that we spent, it's been a remarkable year, and we spent the entirety of this year sourcing, controlling, and constructing this portfolio that we presented to you. By the way, there's a question about PPMs. We have extensive diligence available to anyone interested. So just send us your email. We'll send through everything, comp analysis, pro forma, et cetera. We were looking at treasuries at 5 and banking crisis and supply chain constraints, et cetera. And our numbers kept working at this conservative underwriting. There is a question here regarding refinance strategy, and it is our objective to do a cash out refi and return tax-free a portion of your original investment. So Leo or Jill, do you want to talk about the refinance strategy, refinancing from construction debt to permanent financing?
Jill, maybe you can talk about that, but let me just add something real quick. So when Jeff says the numbers are still working, these are still pro formas, they're models, right? And what I think he's alluding to is our comfort level of permanent financing rates we're feeling more confident on, even though Jill will talk to how we're underwriting to perm rates. That's the key, because construction loans, even though those interest rates have risen and now they're actually coming down a bit, that's not as critical as the perm finance rate, right, Jill? So you can maybe talk more to that.
Yeah, and so that's what I mentioned in the previous response is that at stabilization, so we have the construction financing, and then we have once the property stabilizes, that's when we're underwriting the agency or some sort of takeout life company. And so that would be when Jeff mentions there'd be a debt finance distribution for the investors, should there be the proceeds there. And we're underwriting the lesser of 75% loan to value or 1.25 x debt service coverage ratio at interest rates where we're seeing in the high 5s, sub 6 range. And then, as we mentioned in the previous response, for example, on our Charlotte deal, we that's a live deal that I can just say is as we sensitized the model, we also then advocated and took less in terms of proceeds, because I think it's both, it's nice to get a debt finance distribution, but also, having been through, all of us have been through the last, one of the last financial crisis in 08 and 09. And so that was, working in a real estate development shop during 08 and 09, you see a lot, and especially working with projects that are under construction or about to start construction, and it's being appropriately levered is key. And so while it's great to get the debt finance distribution, it's also important that when we're approaching stabilization, that we can get the construction loan out, because it's about being appropriately levered and having a long-term hold. And so that's in the example of Charlotte, we opted to take a little bit less in terms of the loan proceeds in order to feel more comfortable about that, rather than lever up to the maximum we could get for construction financing. And so that's how we really view leverage. And it's not necessarily of particularly on the construction side of just, maxing it out. It's finding appropriate leverage that gives us the strong conviction that we could take it out. And we think it's the right leverage for the deal.
Excellent. And then we have another question here regarding exit strategy, and I'll defer to you, Leo or Jill, but I will just editorialize. The assets that we are seeking to develop in partnership are what I consider to be institutional class assets, right? You saw the 2 stadium district deals, their proximity to, not only stadium, but universities and other entertainment facilities and corporate employers. So we think these are attractive assets that after approximately 7 years of predictable NOI, that they will be desirous for acquisition. But do either one of you want to talk about our exit strategy planning?
Yeah, I think just quickly, Denver and Nashville, those are, podium build, high quality multifamily. I think those are very likely institutional quality, single asset acquisition from a life company or, any institution type investor. Build to rent, we're already seeing an active, investment class from private equity to, other institutions that are really high on that asset class. So being part with Trilogy, I think there's a chance of aggregating those, as one sale or selling them apart is a strategy we've looked at. But again, that asset class is just continuing to grow. And I think these assets in the middle of these markets that they're in, we're feeling like, maybe they're not big enough for a major life company, but I think there's a lot of institutional type investors that are looking at that asset class.
So I'll call to close here. We're at the top of the hour. I want to thank everyone for their attention and their time. The line of questioning has been fantastic. We've got some actions here as a result of that. We'll get more information to certain individuals. We hope we've illuminated tax planning strategies as we close the year. We hope that we kind of described our investment thesis as to why multifamily OZ real estate investing in 2024. Again, we focused on multifamily exclusively, X other product types like office, retail, etc. And then we went through our actionable portfolio, which is progressing and is available for immediate investment. As Leo says, once again, it's kind of last money in. So we again thank you for your attention, and we wish everyone a happy holiday season and look forward to a great 24. Thanks so much. Goodbye.
Thanks, everybody.